my answer to that is will stay far lower than that. The reason is that the current policy rate is 2.25. So if we raise it by 50, it will be 2.75. And relative to our inflation forecast, our inflation forecast for next year is higher than 2.75. So in real terms, money is still very cheap. So we have plenty of room. The question is, how much of the room do we use?
Okay.
And,
Okay. Sir,
for
related
instance,
question.
okay, let me continue.
Sorry, sir, go ahead.
Even if the inflation pressures from the supply side normalize, we will still have to think of rate increases because the economy is already, the demand and supply are now broadly balanced. So, so sooner or later, as the economy, the demand supply, in fact, it can happen that the demand may actually slightly exceed supply on the aggregate. So, so even without a supply shock, sooner or later we have to adjust the rates upwards. Now, what's happening is because of these external shocks, sooner is what we're doing. As I said, with at the rate it's going, demand levels and supply levels are in the aggregate broadly balanced. And similarly, growth of both potential and actual output are also going to be broadly balanced. So in this case, what we have to revert back to normal monetary policy. Of course, we have to do it gradually so you don't shock the system. And okay, so what are those? Normally, the policy rate will not be lower than the inflation target. Because we don't really want negative real rates, right? So that has to go. Now, exactly when we achieve that, I would say maybe by next year. Of course, how much of that should we do this year? That's really the question. We're going that direction. How much of that we will do this year? The other one is liquidity. Because right now, banks have about more than 2 trillion of funds with us, which they can mobilize if they become very optimistic. So we have to make sure that some of that funds return to us by either our central bank bills or by term deposit facilities. So that's what we have to calibrate. Now, of course, the money supply is affected by government borrowings. So sometimes the government borrows in advance, thinks that it's timely to borrow, so it ends up borrowing and depositing the money with us. That will also reduce liquidity. So that's the other important part, the coordination between the BSP's management of liquidity and the government's management of its own borrowings and liquidity.
Okay.
So we have to be, in other words, we have to normalize both, well, as they say, Q and R, right? Quantitative policies and rate policy. Both of those have to be normalized. The other thing we have to normalize is the reserve requirement. We have a very high reserve requirement. The reason I'm afraid of a high reserve requirement is there are lenders who are not regulated by us. Therefore, they are not covered by reserve requirements. So the last thing I want to do is have a disadvantage that is the banks that are regulated by us are at a disadvantage they're competing with guys who are not restricted by reserve requirements. So we have to reduce the reserve requirements too.
Okay.
And
To that point,
we actually, what we did to help the medium and small scale industries is we said that lending to them will qualify as reserves. That's fine, but as much as possible, we want market-oriented, non-reserve measures to do that. And we hope that the government can set up a guarantee scheme that will make the banks lend more to them.
more to that point,
So that's why we're going to end the reserve qualification of loans to medium and small scale industries. And to prevent that from becoming an unintended tightening, we will actually reduce the reserve requirements. So those are the things that we are doing.
okay. Given that as well, Sir Medalla, releasing liquidity at this stage, is loan growth even enough to actually mop this up? At the same time, do you see levels reaching single digits by 2023 as promised earlier, or at least as envisioned earlier by BSP Governor Ben Jokno?
Well, we'll get 10 already with when we replace. Remember, we're already at 12%. So if we replace the reserve qualification of loans to medium industries, we get rid of that, and we replace that. That will more or less be 200 basis points. So we already reached. So before the end of the year, we will already reach 10. Okay, so technically speaking, all I have to do is make it 9.9, right? Honest. So we will do a little bit more than that. So by next year, we're sure, we're very, very confident, by next year, the reserve requirement will be below 10.